Charlie Munger and Warren Buffett are very careful when it comes to retailers. They can very quickly die if they sleep for too long. So let's look at Walmart, the biggest brick and mortar retail company. They don't only operate in the US, a lot of their stores are outside of the US. But despite that, when we look at their revenue, $161 billion total revenue, only $27 billion come from the international segment. Despite international making around 50% of stores, the Walmart US is just way more profitable. That has many reasons. One, the stores in the US are way bigger. In other countries they're just not as big, but of course a lot of Americans spend way more money in Walmart than in other countries. Some people, they buy everything at Walmart, nothing from somewhere else. And yes, international has a higher growth rate. They're growing at 13% per year, while US is only growing at 6%. But overall, when we look at the profitability, the cash for now is gonna come from Walmart US. It's gonna take decades until international is as big as the US, especially because the growth in the US segment can't be infinite. If you think about it, Walmart's gigantic stores, they only make sense with a lot of population around it and if the next Walmart is further away. So the amount of the big gigantic Walmart stores that they're famous for is limited, and we can see that in the revenue growth. Walmart is not a fast growing company. Well, yes, they had an acceleration in revenue, but only when inflation started to kick in. So most of its revenue growth is just pure inflation. Walmart only grows by like 2 to 3% per year in revenue, net inflation. So it is not a fast grower, the US segment is very saturated. Most of the revenue growth will come from international. The US segment, maybe 1 to 2% growth due to GDP going up, but only slightly outperforming inflation. But when you think, hey, they have e-commerce, and that is growing fast. Yes, but e-commerce will not be as profitable for Walmart as for stores. And here they're fighting with Amazon, who's a very big competitor. So this is a very risky segment. Well, yes, it can bring some additional growth. It will not bring a lot, especially because the brick and mortar business is so big that slight e-commerce growth will not tip the needle. Their free cash flow is very volatile, that's just because it's a retail company. An example of how volatile free cash flow can be in retail companies is Target. Sometimes they have very great free cash flow, sometimes it's in the negative of billions. This is because of inventory. If you mismanage your inventory for 1 quarter, there goes all of your free cash flow. Of course, over the long term it's a bit more stable, but if you look quarter by quarter, it will vary a lot. That is also probably why they only show year to date. So if you want to look at cash flow from these companies, you need to look at longer terms. So now that we determined that revenue growth at Walmart will not be great, maybe a bit from international, slight revenue growth from the US, maybe 2% net of inflation, well, maybe they're gonna win on margin. I mean, we hear it all over the news. Automation is coming, self-checkout, they will be less reliant on employees. That is surely gonna help margins. And we can see, no, it doesn't. This is what Charlie Munger and Warren Buffett mean. Despite investing billions in modernization, Walmart's margin are not improving. That's because everyone else is doing the same. You can invest all these billions, but it's necessary. If you don't buy the self-checkout cash register, which lowers your expenditures by maybe 2%, well, but your competitor will. And then he can lower the prices by 2%. So now your prices are 2% higher because you didn't invest the money into the self-checkout. But overall, no one here really made money. That is just the expense of running the business. This is very low margin. So despite you investing billions of dollars, this is just you doing what the competition is doing. You improve your margins, you can lower price to hurt your competitor, you do it, your competitor does it as well, and so on and so on and so on, and the margins never change. Profit margins in effect have been slightly declining, free cash flow margins mostly stable, but we can see how much have stores changed since 2015. Cleaning robots, self-checkout, supply chain improvements, and despite that, no margin improvement. This is the issue with retail. All these retailers run on a thin profit margin, and if you can lower your prices by 0.5% while the competitor cannot, that will crush them. That is why all these improvements will not change anything. This is just how capitalism is. This is why we love competition as consumers. And when I see that free cash flow has not changed much since 2015, and that the stock price since then has around tripled, in my head it immediately goes, is this really a good investment, or is this maybe overpriced? I mean, a P ratio of 31. That is nearly a Microsoft PE ratio for a stock like Walmart. Now, I'm not saying they're about to go bankrupt. They have 20 billion of free cash flow and only 50 billion in debt, so there is no risk there. But overall, I just think the growth is not there. With a high valuation, where's my return gonna come from? So now when it comes to valuing Walmart, even if we give them a slightly higher free cash flow per share than they have right now, growth rate of 5 and 4%, long term, if inflation comes down, growth rates are gonna normalize, free cash flow has not moved up a lot, most of this is gonna come from buybacks, maybe slight growth in international, but it is not gonna be a lot, and I wanna be conservative here. 10% recurrent return, 18 multiple, payout ratio of 35% with a slight deduction due to taxes, well then we come to a $95 intrinsic value. The stock is currently at 164. So first I see, with my conservative assumptions, which are not too conservative in my opinion, this is not gonna go that well. Slightly higher growth rates and a 20 multiple, then we would come to 118. Still not the current value. What if it goes even worse? They continue to have basically no growth in free cash flow. 15 multiple, which is still fairly high for those growth rates. 73. Well, what would need to happen so that we can justify this investment at 10%? Well, let's say they grow at 10% and then 9% after that. Well, then we would come close to the value, but 10% and 9% is very ridiculous. This is for free cash flow per share growth. So even with buybacks since 2016, there has been basically no growth. I don't see where this 10% would come from. So in my mind, I will just not add Walmart to my portfolio right now. It is a good company, but it is the retail sector. It's hard to grow margins there, so I don't see big growth coming from Walmart. What do you think? Write it down below. Have a good day.